Hi, I'm Rod Jones, and first of all, I want to thank you for your interest in our farm transition series in general. This short presentation is going to be a follow-up to a previous segment where we began to address those issues that need to be considered for the quote-unquote retiring generation during a family business transition process, or those stakeholders who are going to be phasing out in some way, shape, or form of, to a large degree, their management roles in the business. So whether that's a gradual process or a one-time event may depend on the situation. But there are several issues that need to be considered. So first, as an introduction, I'll just give you a brief outline of what's to come. First of all, we need to think about the retirement lifestyle, and that's important in a number of different contexts. But here I'm thinking about not only what those individuals want to do as they phase into retirement, but more pertinent to today's discussion, how we're going to fund that retirement process, or how the business stakeholder team as a unit is going to fund the changing roles of the various stakeholders within the business. So we're going to think about financial needs, we're going to think about income sources and the risks or potential risks associated with those potential income sources. And obviously we're going to think about some spending projections and some considerations on the spending side of the equation. And finally, we're going to wrap up by thinking about a few pitfalls that may be experienced along the way. So first of all, anticipating the lifestyle. As with anything, it seems, in life, what you want to do or what you envision yourself doing in retirement is certainly going to dictate the finances that will be needed to facilitate that. Whether you want to envision a more luxurious lifestyle with a lot of travel, perhaps consuming some luxury items in retirement, that's obviously going to take more money to fund than if you envision a lifestyle that involves perhaps a more modest set of standards, or maybe even what would be considered a more traditional set of standards, or something maybe more aligned with what you've been used to. One point I want to make, based on recent data, and keep in mind, life expectancies are improving all the time. As this graphic shows, a 65-year-old male today has a 75% chance of living to at least 78 years old. They have a 50% chance of living to 85, etc., etc. As the second line there indicates, females typically live longer. And so, for example, a 65-year-old female today would have a 75% chance of living to at least 81 years of age. And then the red line indicates that one or the other, at least one spouse of a married couple, if you're 65 today, you have a 75% chance of living till at least 86, and you have a 1 out of 4 chance that at least one of those spouses out of a married couple, if they're both alive today and both 65, would live at least 30 years, at least till the age of 96. The main point for this slide: plan for a long time of financial needs into retirement. Let's talk about potential retirement income sources. Some of these I'm going to focus on more than others, so I'm going to go through them with a slide or two dedicated to each one. Here's the list. Spousal income, I'm not going to talk about that one a lot in detail, but obviously sometimes there are some situations where one spouse wants to retire a little earlier than the other spouse, or one spouse perhaps has some income sources that have come to them through some other means. We're going to spend a little bit of time talking about Social Security. We're going to spend quite a bit of time talking about the potential of income from the farm assets that this individual may have invested in throughout their lifetime. Other savings and investments, perhaps the opportunity for at least some part-time work in retirement and other retirement type vehicles, pension plans, etc. So, Social Security. As most of you probably know, the minimum age to start receiving Social Security is 62. You get 80% of your projected benefits if you start taking Social Security at that age. Age 65 or more. And as you probably know, that's ramping up slightly legislatively depending on your current age. But by the time you reach 65 on up to 67, depending on your current age, you would be eligible to get the full Social Security benefits. Retirement benefits increase each year that you delay taking those retirement benefits up to age 70. And just a few more details about the Social Security program. There's no reduction in Social Security benefits no matter how much you earn after you reach the age of 65. So between the age of 62 and 65, earnings may count against your Social Security benefits if you elect to take Social Security benefits during that time period. Big important point here, you can check your Social Security earnings record and your projections for Social Security benefits that you would be eligible for by logging on to the Social Security Administration website at the address that you see on the screen there. Now, the bottom line here at the bottom of the screen is a important point about Social Security, particularly for people who have been primarily self-employed much of their life, which would include a lot of our farm audience. People who've been self-employed may have utilized a tax management strategy throughout their entire career that may have involved trying to minimize taxable income, and as such they may not have accumulated much in the way of Social Security earnings potential. So you need to look. Younger people may want to consider that as they're planning their entire retirement portfolio, depending on your personal philosophy about whether Social Security will be around or not. If you are approaching Social Security age, I would encourage you to log on to that Social Security Administration website, check your earnings history, and see if that might be the case for you in particular. If you may have chosen throughout your life to minimize Social Security earnings in order to minimize the tax consequences, that may come back to bite you just a little bit as you get into retirement if you haven't accrued very much in the way of Social Security earnings or credits. I want to spend a little bit of time talking about income from the farm assets in a couple of different contexts. A lot of people say, well, I'll just live off the rental income from the assets that I've accumulated. So a couple of points to consider here. Point number one, if you are considering the land resource, keep in mind it takes a lot, because the rent to value, if you will, ratio for agricultural land is not very large. In other words, as a percent of the total value of that land, the rental income, or the income that somebody who is in retirement and is counting on income from that resource, that's what they're going to get, is not very large relative to the total value of that asset. And I've given a couple examples here. $40 an acre cropland rent. I know that's low for some areas of Oklahoma, maybe about right for other areas. $22 plus or minus for pasture land. So if you had only cropland and you were expecting the rental income off of that cropland to spit off $50,000 in cash income, for example, you'd need a lot of acres, 2,000 acres plus of pasture, or 1,250 acres plus or minus of cropland, or some combination. The second question is, it may not be paid for yet. A lot of people purchase land on very long-term land purchase contracts, so there may still be principal and interest payments that need to be made on that land, and those don't go away just because you retire, as you probably well know. Down there at the bottom of the screen, a couple of other types of assets that may be available to lease out. Beef cows or machinery and equipment. Of course, those rental arrangements are very common. Somebody who's phasing into retirement has some assets that they can lease to somebody else, the incoming generation, or somebody unrelated. One thing to keep in mind is those are income streams that don't last forever, because those assets depreciate, and if you want that income stream to last for a long time, there's going to have to be some reinvestment that will have to be planned for and accounted for. Okay, maybe I don't want to rent these resources out. Maybe I just want to sell them to the next generation or to some other interested party. There are a couple of pitfalls associated with that strategy. Be wary of low basis assets. You may get hit with capital gains taxes or income recapture, having to pay income taxes on some of the proceeds associated with the sale of some of those assets. So those are just a few pitfalls associated with relying on the farm assets exclusively to fund retirement. Let's move on to some other things to consider. I've often heard the statement that I don't need a retirement plan. I'm a farm manager, and this farm's been successful, and it's been funding my living needs all along. It can just continue to fund my living needs as I phase into retirement. Be careful of that, because that's not going to be true if somebody else is going to be doing the work. That person will need that portion of the income that business is generating. So the operator return portion of what your business has been generating may need to go to somebody else as you phase into retirement, and that's a common pitfall as I work with individuals thinking about how they're going to fund their phasing out of the farming business. Just something to kind of keep in mind. We've got traditional savings vehicles that may be able to contribute some to this retirement funding pool. Traditional taxable accounts, savings accounts, CDs, bonds, stocks, mutual funds, etc. We've got employer-sponsored plans. If this person has worked for somebody else at some point in their life, perhaps they've accumulated some wealth in 401ks, 403bs, profit-sharing plans, etc. Several options are available that provide some tax advantages relative to the taxable accounts that I talked about a little bit on the previous slide. Either some front-end tax benefits, contributions deductible on the front end, or some back-end tax benefits. The withdrawals may be tax-free or tax-reduced. So there are several vehicles that we need to mention here. One thing that I would mention is on the 401ks, 403bs. One of the pitfalls that I see is people not participating in those when they have the chance to participate in them, especially if there is an employer match associated with that vehicle. Some people choose to not make their 4% contribution, so they don't get the 4% that the company's putting in. That's just free money. So as you plan a long time in advance for these events, don't allow those opportunities to slip away and not take advantage of them. One point I want to drive home, and as we continually discuss with our 20 to 22-year-old students here on the campus at Oklahoma State University, if you have a lot of time, it doesn't take a large monthly investment to grow quite a bit of wealth. Here, this table shows what the monthly investment required would be to accumulate $1 million. And if you have 40 years and you can invest that monthly contribution in something that earns, say, a long-term historical stock market return, conservatively 8%, maybe not so conservatively 10 or 12%, as you can see here, if we had just put away a few $100s a month, we will get there if we have 35 or 40 years. If you don't have that amount of time, it can be much more difficult to accumulate some of the larger sums that might be required to fund a retirement. So time is your friend, as we always say in planning for retirement. Just a message for the younger folks that may be considering some of these strategies well in advance. Then there's the problem that $1 million that I just talked about on the previous slide may not be what it used to be. In fact, for a 20-year-old today, we just did some of these calculations within the last few days. A 20-year-old today, it may take $4 or $5 million in 45 years to look like what $1 million looks like today. So there's that decreasing purchasing power over time, that inflation risk. There's the tax risk, of course. Big Brother always wants to come in and take a chunk of it, right? So changes in the tax laws could lead to some kind of a shortfall relative to projections. There's always the financial market risks. Your investment portfolio may tank at the most inappropriate time, as we've all seen that happen to various individuals. And finally, the risk that you may outlive your money. You may be one of those 5 or 10% that just live a very long time. The point is, there are things to consider if you plan on using these investment tools, the IRAs, the 401ks, and the long list of other similar alternatives that are available to fund a significant share of retirement. There's also the possibility that you may want to just continue to generate some income in retirement. Work. Supplement these other sources of retirement funding with part-time work. Could be within the existing family business, could be something that you completely want to transition to something a little different. Fits some people. I will tell you personally, it's not what I envision for myself in retirement, but heck, if you enjoy doing some things, whether it's associated with the family business or whether it's in some other endeavor, certainly nothing wrong with that. Just keep in mind you're probably not going to be able to work as hard and generate as much income post-retirement as you do pre-retirement. So some things to consider. We add up all of those sources, the spousal income that I didn't talk about very much, the Social Security potential, the income that could potentially be reaped from farm assets, savings and investments, perhaps working at least part-time during retirement. I haven't talked a lot about pension plans, a guaranteed income stream, but we've seen examples recently regarding how those quote-unquote guaranteed sources may not be as guaranteed as we think they are if things go wrong for the potential funding source, even in a pension plan environment. So there are pitfalls associated with that. Point is, it's nice to have a mix of some combination of several of these sources, because they may not all be quite as reliable as we would like for them to be, and it's hard to predict which ones may experience a shortfall. Then we think about what we're going to need to live on in retirement. Family living needs, kind of that age-old rule of thumb, somewhere around 80% of the pre-retirement income needs may be needed in retirement. Some of your expenses are probably going to be a little less as you get into retirement. You probably have your home paid for. You're probably not going to have a mortgage payment on a home. Your children are probably going to be gone. You're probably not going to be spending as much on educational expenses, etc., for children as you were pre-retirement. Some expenses may actually go up, but kind of that age-old rule of thumb is you could probably get by with a little bit less post-retirement for most people than what was required at least a little bit earlier in life. Second point there, will you still be involved in the farming operation? Will you still be paying some farm expenses? Maybe being expected to participate in some capital expenditures. How long do you expect to live? We've talked about that one a little bit. Health insurance is getting to be more and more of an issue, and probably will be an ever-increasing expense even as we phase into retirement, depending on what's available at that time. But I don't foresee that becoming less of an issue. I foresee it becoming more of an issue. Long-term care insurance. Are you going to need that, and what's it going to cost? Life insurance. Are you going to need to purchase some life insurance to perhaps facilitate some other aspects of the farm transition plan? Taxes. What's going to be your tax burden? Are you going to need some emergency funds? And we've talked about the potential for inflation to eat into that retirement nest egg. Bottom line, we need to create a retirement spending budget, just a listing of our potential expenditure items and needs and an amount associated with those items, so that we can get a handle on what that post-retirement spending plan might need to look like. And then we need to, of course, keep in mind that amount is going to inflate over time. Here's a visual representation of that inflation point. For example, in 20 years at 4% inflation, it's going to take almost $22,000 to buy what that $10,000 that we started out being able to utilize today would buy. So if you live 20 or 25 or 30 years into retirement, it's going to take a lot more money, depending on what your projection is for an inflation rate, etc. But we know it's not going to be zero, so we know it's going to take more money to buy that same bundle of goods, that same lifestyle, as we get into the later years of retirement. In today's dollars, in order to draw, say, 50,000, I'll just kind of focus on the 50 to 52,000. In today's dollars, in order to draw 50,000 or 52,000 out every year, you'd need almost $1 million in some mix of assets. If you thought that mix of assets could earn 5, 6, 7%. So here's a table showing your projected rate of return on your retirement portfolio, and then the amount of money that you would need to accumulate in order to fund a certain level of continual withdrawals as you go into retirement. So the point, it's going to take a lot. It's going to take a significant chunk of assets, chunk of wealth, to fund an individual or a couple's retirement based on today's life expectancy projections. As you get close to retirement, there's some planning issues. How much retirement income will you need? That's what we've been talking about. How do the farm or business assets play into that retirement plan? Don't forget to think about what you're going to do in retirement. And just as importantly, have you talked about that retirement plan with others? Very frustrating for other stakeholders associated with your life or your family business to not know what the plan is, even if your plan is to continue to be relatively heavily involved in the farm or other family business, because that's what you want to do. That's fine, as long as we've had some discussions about that with others so that they can help you come up with the best plan for your situation. Some pitfalls to be aware of, cracks in the nest egg, if you will. Time is your friend. Take advantage of that. You would be amazed. Again, I mentioned this earlier. You would be amazed at how many people I talk to that fail to participate in employer-sponsored plans that involve an employer match into their retirement contributions. That employer maybe they'll match the first 4%. If you'll put in 4%, they'll put in 4%. You'd be amazed at the number of people I talk to say, well, I can't afford to put in 4%. Well, they're just giving away that free money that would essentially be a pay raise from that employer. And most employers this day and age do have some sort of an employer match on a 401k or some similar type of retirement vehicle. Then there's the issues, again, that we've already talked about: miscalculating how much is enough, failing to consider long-term care needs, failing to consider inflation and taxes, underestimating life expectancy, underestimating expenses in retirement, investing too conservatively early. Some other things to consider: failing to protect your assets, making large loans late in life to family and friends. That always works out great, right? More often than not, that doesn't work out just exactly the way that you planned for it to, and it may significantly cut into your retirement nest egg if those people can't or don't pay you back in a timely manner. As illustrated before, trying to outtime the market, trying to overly manage a retirement portfolio usually doesn't work out very well. The average individual investor almost always underperforms the stock index type funds or the professional fund managers who rely on indexes or some other type of a mechanical strategy. Individuals trying to outtime the market usually don't come out ahead, whether it be equity funds or whether it be fixed income fund type investments. History has not been kind to people who try to outtime the market. Point is, we're just not psychologically wired to outguess markets, so please don't try, especially late in life as you're preparing to phase into retirement. So in review, we've talked a little bit about anticipating the lifestyle, primarily as it pertains to financial needs. It's also important to anticipate that lifestyle and have some discussions with other stakeholders about what that lifestyle will look like just in the context of what you plan to do. Evaluating various income sources, a long list of potential income sources, developing a spending plan, carefully managing that retirement portfolio as you get closer to retirement, and matching that retirement plan with other estate planning tools is very critical, especially as we approach that important time. Again, as always, thank you for your time. Appreciate your interest in our Farm Transition series. As always, our workbook, along with a wealth of other information, is available on our Farm Transitions website, as you see on the screen.